Hey everyone, welcome to The Explainer. Today, we are zeroing in on a really crucial piece of compliance and sustainability analysis. We're going to unpack the absolute foundational layer of the version 2025-12 Insurance Sustainability Accounting Standard. Look, if you're dealing with ESG data, sustainability reporting, or risk analysis in the insurance world, you already know just how incredibly complex this data can get. It's like a giant puzzle. But today, we're cutting through all that noise. We are getting right down to the mathematical bedrock of it all.
I want you to just think about this scenario for a second. How do you actually compare the climate risk or, say, the financed emissions of a massive multinational insurance conglomerate against a tiny single-state regional provider? It's tough, right? If you're just looking at the raw numbers, like the absolute monetary losses or the total greenhouse gas emissions, that massive global insurer is always going to look infinitely riskier and way more carbon intensive. But that raw data doesn't tell the whole story, does it? We need a way to level the playing field. Basically, we need a denominator. Okay, let's dive into this. To solve that exact comparison problem, the SASB standards give us a highly specific tool, and it's laid out right there on page 3. They are called activity metrics. By definition, these are metrics that quantify the scale of an entity's specific activities or operations. And the whole point of them is to be used alongside other sustainability metrics to normalize your data. That's what allows for true apples-to-apples comparisons across the industry.
So here's our roadmap for today. First, the baseline of reporting. Second, we'll meet metric FNIN000.A. Third, we'll cover the 3 key segments. Fourth, we'll look at disaggregating the data. And fifth, normalizing your data.
All right, let's kick things off with Section 1, the baseline of reporting.
Moving right along to Section 2, meet metric FN-000-A.
Now, what's genuinely fascinating here is that we are literally looking at the source code of compliance. This formulation is pulled straight from the standard itself. It gives us the activity metric, the category, the unit of measure, and of course, that specific code, FN-IN-000.A. Notice the unit of measure here is simply a number. Specifically, we are talking about the number of policies in force. You really got to understand that FNI000.A is the absolute foundation for basically every other sustainability disclosure in this sector. I mean, whether you're trying to track your financed emissions all the way down to Scope 3, or you're calculating your probable maximum loss from weather-related natural catastrophes, this single quantitative metric, your policies in force, is the bedrock. You literally cannot accurately frame your performance in any of those complex areas without first knowing exactly how many policies you actually hold.
Which brings us to Section 3, the 3 key segments. The standard is very strict here. It requires mandatory disaggregation into 3 distinct segments. Number 1, property and casualty. Number 2, life. And number 3, assumed reinsurance. I really want to be clear for the folks in the trenches actually pulling this data, these are rigid required categories. They are not suggestions. When you report your total number of policies in force, they have to be bucketed neatly into these 3 specific silos. No exceptions.
But wait, before we move on, there's a highly specific yet absolutely crucial detail hidden on page 4 of the source text. You're probably thinking, okay, where does health insurance fit into this? Well, the short answer is, it doesn't. Health insurance metrics are intentionally excluded from this specific FNN standard. They're actually outlined entirely separately over in the Managed Care or HMC/MC industry standard. Knowing that little fact is going to save you from a massive compliance error right out of the gate. Seriously, do not mix your health insurance policies into this calculation.
All right, Section 4, disaggregating the data. Time to get practical.
Let's move to and see how this actually builds into a functional day-to-day workflow. Step 1 is straightforward. You query your systems to aggregate the absolute total number of policies currently in force across your entire entity. But step 2 is where the actual compliance heavy lifting happens. You have to take that massive total and parse it out, allocating every single policy into either property and casualty, life, or assumed reinsurance. Doing that meets the baseline requirement. But interestingly, there is a step 3. If you dig into footnote 4 in the standard, you'll find this exact quote. The entity additionally may disaggregate the number of policies in force by product line.
So while those 3 core segments we just talked about are mandatory, the standard actually gives you the option to provide even more granular data by product line. Now, why on earth would you create more work for yourself voluntarily? Well, because if you're trying to prove to your investors that your risk is incredibly well managed, showing them a detailed breakdown, like say separating out your coastal commercial property from your inland residential property, that provides an unbelievable level of transparency. It's a game changer for building trust.
And finally, Section 5. Normalizing your data. And this brilliantly illustrates exactly why we go through all of this effort in the first place. Imagine you were just looking at raw, absolute data, say 500,000 metric tons of absolute gross financed emissions. On its own, that number is frankly terrifying, and worse, it's completely devoid of context. But then, look at the normalized data. By dividing those absolute emissions by the number of policies in force, using our new best friend, metric FN in 1000A, we suddenly have our emissions beautifully contextualized per policy. This is what makes true peer-to-peer comparison possible. Now you can actually compare that massive global insurer to the small regional provider based on their true operational efficiency and risk intensity, not just their sheer size.
It's also super important to recognize the global weight of this entire methodology. As of August 2022, the International Sustainability Standards Board, the ISSB of the IFRS Foundation, actually assumed responsibility for the SASB standards. So this method of normalizing data through activity metrics, it isn't just some niche reporting quirk anymore. It is a globally recognized foundational practice that aligns perfectly with the IFRS S1 and S2 frameworks. So what does this all mean for you? Well, it comes down to the timeline. The ISSB took the reins in 2022. They made a series of rolling amendments through 2023, and crucially, they amended the financed emissions metrics in December 2025 to align with greenhouse gas emissions disclosures. But the date you absolutely need to circle in thick red ink on your calendar is January 1st, 2027. That is the effective date for this version 2025-12 of the standard for all annual reporting periods. Which leaves us with one final, pretty urgent question to consider today. Are your entity's internal data systems actually capable of properly disaggregating your policies in force right now so that you're ready for that January 2027 effective date? The standard is set, the methodology is totally clear, and the clock is officially ticking. Now's the time to ensure your reporting foundation is rock solid. Thank you so much for joining me for this explainer. Now get out there and take a closer look at your own data.